Option trading can make you a lot of money. It can also lose you a lot of money as well, unless we learn to trade them correctly and effectively. Over the last few years, I've tried pretty much all the strategies out there. Buying calls and puts, selling covered calls, cash secured puts, strangles, straddles, you name it, the list goes on. But the one strategy that I found to be most successful is the iron condor. In today's video, I'm going to teach you how to trade an iron condor on Robinhood with live examples, which is probably the easiest way to learn and get a grasp of everything, especially as a beginner. Now, we are going to go through 3 scenarios step by step to make sure everything is covered. First, we will learn how to open the trade on the app. Then we will see what happens during the trade and what we should be looking for. And then we'll take a look at actually closing out the trade, as I know this is where people might get a little bit confused. We will also take a look at what happens if the trade goes against you and you end up losing money, which is something that we should just all know how to handle. Now stay tuned till the end of this video because I will share with you my checklist for steps to follow whenever I'm placing an iron condor trade. Now if you wouldn't mind hitting that like button before we start, just a little tap, ding. It really does help out the channel a lot and encourages me to make more videos just like this. Alright, you clicked? You're subscribed? Alright, good. Now we can move on. Grab your Robinhood app and let's begin. Now, before we jump into the app, I think it's important to understand what an iron condor is. I mean, that would make sense. Now, to break it down in simple terms, when you buy options, you are hoping for directional moves. When you buy a call, you are hoping that the stock goes up. When you buy a put, you are hoping that the stock goes down. If the stock goes in the direction that you want, you will end up making money by the option contract increasing in value. Now on the flip side, when you sell options, for example, you are hoping that the stock does not have a strong directional move. So when you sell calls, you are hoping that the stock does not reach your strike price. When you sell a put, you are hoping that the stock does not drop below your strike price. Now, you're not necessarily hoping that the stock goes in the opposite direction, but slowly moves towards the strike price, just not surpassing it. Now, with an iron condor, we are not taking a directional stance on the market. This is in fact a neutral stance by saying that you think the stock or index fund that you will trade flat, as in not a crazy move up and down in any direction. So with an iron condor, what we want to do is pick 2 points to start. You will pick 1 point above the current stock price and 1 point below the current stock price. So to win this trade, we want the stock to trade in between these 2 points that we chose. If by the expiration date the stock stays in between these 2 points, then we will win the trade and make profit. An iron condor consists of 4 separate option trades. We are selling a call where we think the stock won't reach, and then we are selling a put where we think the stock won't drop below. These are the 2 points that the stock needs to effectively trade in between. We are then buying a call higher than the call that we sold for protection, and then we are buying a put lower than the put we sold again for protection. Now, I like to think of these 2 option buys as sort of hugging around the trade because you're hugging for protection. Get it? It just makes it easy for me to remember. Okay, so when we open up an iron condor, we are not paying out any money like we would be when we buy options. We are actually collecting a credit just like we would be when we're selling options. So we are receiving a credit for putting on an iron condor trade. Our ultimate goal is for us to collect a credit and then have that iron condor premium price drop in value or expire worthless. If it drops in value, then we can close the trade out and keep the difference, which will be our profit. If it expires worthless, then we don't need to close out the trade and it'll just expire at $0 and then we get to keep the entire premium. So that is a basic summary of what an iron condor is. If you want to watch a more in-depth explanation on the iron condor, you can click right here. I did a full video on it so you can learn as much as possible before jumping into these live trades. So as long as you know that, get your Robinhood app and let's get into the examples. All right, taking a look at SPY, this is what I usually trade iron condors in. Now the price is sitting at around 460. It's a pretty flat day, so I'm going to go ahead and trade an iron condor for that. Go trade options. Now the dates themselves don't really matter. I filmed this about 3 weeks ago, a month ago, so the dates are going to be reflective of that. And we're going to pick an expiration date. Now usually I like to go out about a month away. So at the time of recording, a month away is about February 7th. But because we are filming this video and I want to get the results sort of as quick as possible, so I can edit all this, I am going to go with a expiration date, January 7th, which is the next one out. And that's, again, just for explanation purposes. Again, I usually go out at least 1 month, all right? So we're going to go ahead, select, so we can go ahead and select different options. And we're going to go to sell call as our first option contract that we want to put on. We're going to sell a call. So we're going to go out to the chance of profit of around 85%, all right? 85% chance of profit, which is about a 1 standard deviation move. We're going to select that, and then we're going to buy a call on top of that, and we're going to buy a call with 2 strikes away, the 475 call. Now we're going to go and switch to sell put. So now we're going to sell a put, and we're going to go down to where the chance of profit is, again, 85%. And then we're going to, again, buy a put below this. So we're going to go buy put, and we're going to go 2 strikes below that for the 461 put. This is the one that we're going to buy for protection. And now you can see that the trade is already set up for you. Robinhood already sets it up as an iron condor. So you can see your 4 different trades that you are making all together as one. So if we go down the list of the contracts that we are entering, we are buying a call and we're paying 16 cents for that. We are selling a call and we're collecting 39 cents for that. And then moving on to the put side, we are selling a put and collecting 51 cents for that. And we are buying a put for protection and we are paying 30 cents for that. So the total credit received is 45 cents that we are taking in as credit for putting on this trade. Now we can take a look here at the break-even price, the max loss, the max profit. Obviously, the max profit is the credit received. You can't make more than the credit that you're receiving for this trade. And you can see here, this is where SPY needs to trade in between for you to collect that max profit on this trade to keep the entire premium, right? Of course, the max loss is these 2 points here, the points above the break-even price and below the break-even price. So you can see here a max loss of $155. Now we're going to go ahead and make this trade. So if we put 1 contract in, you can see that we are collecting $44. Now, of course, depending on your amount that you want to trade, you can go ahead, stick with 1. I'm going to do 10 for the purpose of this video. So I'm going to put on a trade of 10 iron condors, and 10 contracts gets me a minimum credit of $450, $60, somewhere around that range. Now, if you want to do 5, of course, you could do 5, half of that, and you're going to collect $230. 20 contracts, you'll get $900, so on and so forth. You can do as many or as little as you want, of course, depending on liquidity. Now, I do believe that Robinhood has a max for this, but nonetheless, we're going to do 10 contracts. We're going to collect $450. Now, of course, take a look at your bid-ask spread. It might, fluctuate a little bit because of that. And again, taking a look at the break-even price and the max loss and the max gain after you put in your number of contracts. Now, you'll see that the collateral that we have to put up is around $2,000, which is definitely less than if you were just selling a put or selling a call by itself. We're putting up $2,000 of collateral. Now let's go and put in 43 cents, the bid price, so that we know that we can get filled right away. Just, again, the purposes of this video. And we are filled. So now we have the collateral out of our buying power, and Robinhood is keeping that. We have 10 out of 10 filled, and we received a total credit of $430. And there you go. We just got the email confirmation for that. And we've completed this trade. So let's see how this goes for us. All right, a bit of time went by, so let's take a look at how our trade is doing. SPY is trading a little down at 467. So scrolling down, we can see the stats. We have our 40 contracts, 10 of each that we put on, and a negative value of $340. Now, what does this negative value tell us? So this tells us how much value is left in our contract. If we were to close the contract right now, we would have to lay out $340. Now, remember, we collected $430 to put on this trade. So this number started out at 430, and our ultimate goal is to get it down as low as possible. So now this is good. It is below 430, the credit received. It is now 340. That means we are in the profit. We want this to get to 0 or close to 0 if we want to win this trade. And you can see just that our total return is 20%, which is around $90. So right now we are in the profit, $90. 430, the credit received, minus what we now have to pay to close it out at this moment, which is the value negative 340. So if we paid 340 but we collected 430, we have a total profit of $90. Now if you want to take a look at each individual trade on its own, you can click on each individual contract to see how that is going. Remember, our ultimate goal is for each of these contracts to expire worthless or close to $0 as possible. So you could click on each of them and see how they are doing. But so far so good with this trade. We're up around 20%. So if you want to close out this trade right now, we would be in the profit. But let's wait and see how it does. Alright, more time has gone by and hopefully our contract is losing more and more value as we get closer and closer to the expiration date. So let's see how we're doing. Scrolling down, we can see we are in the profit. Nice, 65%. Now, for me, when I see 50%, I start closing out the contract. That means I start buying back the contracts at around 50%. So 65% is a very, very good return for this. And you could see our value left in our contract is $160. So we collected $430. So if we were to close out this contract right now, we would pay $160, which is the negative number that you see there for the value. We collected $430 to start. We now have $160 left. That means we have a total return of $270, which also shows right there. Ooh, make that $280. Nice. Alright, now we are very close to the expiration date and let's see how our trade is doing. So if you look down here, we are well in the profit. We are 88% profiting on this trade. We are collecting a total of $380 as the total profit if we were to close this trade out. Our contract only has $50 left on it. So again, the credit received $430 initially that we got for opening up this trade. And now we have to pay only $50 to close it. That means we are keeping the profit of $380, 88% return. This is amazing, and if you want to close it out, you can close it out, but just for argument's sake, I'm going to hold it just a little bit longer so you can see how it looks with 100% return. Alright, it's near the end of the day. This contract is about to expire. Now keep in mind one thing. This trade I've done with just a 1-day expiration. You don't want to do that because it will fluctuate up and down, and sometimes you're going to have to wait until the very last second to see if your contract expires in or out of the money, and you don't want to do that. So typically, again, 1 month out, and usually you can start seeing returns about a week, 2 weeks into the trade, and you can close it then. So you don't have to stress and wait till the very last second like we're doing here. But nonetheless, let's take a look. We are at 100% return. That means the total $430 credit received at the beginning of this trade, we are now keeping. The value of our contract is 0. So this means SPY traded in between our two strike prices, and at this point we don't have to do anything. We don't have to close out the position because you are already at 100%. The value is 0, so there is nothing left to do with this trade. So remember, by not buying back the contract, by not laying out additional money, you are essentially keeping what you received in the beginning, $430, and you've collected all of it and are keeping all of it. So good job, we did it. All right, now I want to take a look at closing the trade early. So instead of waiting till expiration, we want to close the trade out when it is at, a certain amount of profit that we are happy with. So right now we put on a trade and we are up around 52%. So again, like I said before, this is a great return for me. You can see we received an average credit of 25 cents to begin with, and the current price is 12 cents. So that's good. It's going towards 0. We want that number to go to 0. Now, once you get a little bit more advanced in the different contracts, you will be able to close these out one at a time. And to close out each of them, all you have to do is go into each individual one. And if you sold a call, you would have to buy it back. If you bought a call, you would have to sell it, right? So you do the opposites to close it out. But the easiest thing to do is just go down here. Don't even worry about the individual ones. Just click trade and then you'll see close right there. And that is closing out the position. So that is going to reverse everything that you did to open it, and you will close the contract. So we had 10 contracts, so I'm going to go ahead and enter 10. And I'm going to go ahead and put my price at close to the ask price so that we can get filled right away. We are paying $140 to close this contract, but we already received around $250 for this trade. So we get to keep the difference as profit. We swipe up to confirm and we get filled pretty quickly, and our collateral now will be released. And we had a pretty successful trade. All right, let's talk about losing trades now. And when the trade goes against you, what does that mean? So we're going to go ahead and put on a trade and collect $520 of credit. So now we received $520 into our buying power right away. And let's see how this trade is doing. So we are right now in the negative. And this usually happens right when you put on a trade because of the bid-ask spread. If they are a little bit too far apart, you might get a negative number to begin with. But this is the perfect example to show you how that looks. So you can see we are down 5% right now, and the value of our contract is negative $550. Now, what does that mean? Again, this is what you have to pay, $550 to close out this position. But remember, we received $520, so now we are paying more than we received. This is why we see a negative total return of negative $30, because we have to pay more than the credit that we received. This is no good. And this will fluctuate up and down, but if you get to a certain point where you feel like you would rather take the loss and move on to a new trade, then you can do so. Right now, if we want to take the loss, we would have to pay $30 of our own money to close out this position. And again, for iron condors, you are selling options. Basically, you are collecting premium. Then theta is on your side, time is on your side, and as that option gets closer and closer to the expiration date, it will lose value. Whew. All right, we did it. So hopefully now you have a better understanding of what it takes to make profit with iron condors. Now, let me share with you my checklist for things that I look at when putting on these trades. This is more of a step-by-step guide, so you don't miss anything along the way. And of course, this is just what I do, so I encourage you to take this and sort of fit it into what feels right for you. Okay, the first thing that you want to do is pick your stock or your index fund that you will trade. Some work really well and others are just terrible for this strategy. Next, you want to determine your expiration date. You have to pick a good expiration date that will bring you a good size premium. Next, you pick your strike prices. Look at the strike prices, make sure the liquidity is there, make sure your probability of profit is in your favor. After that, you want to determine what profit you're going to get and if that risk reward is worth it. If it is, then boom, we're ready to go and put on that trade. At this point, you want to keep an eye out on that trade and take action if needed. If it's going against you too much, then you might want to cut your losses. If it's going in your favor, then you might want to start closing out your positions, depending on how much profit you have and how long you have until expiration. Finally, if you don't close out your trade early, then you just want to wait until it expires worthless so that you keep the entire premium. But remember that waiting until expiration means you might have to wait until 2 weeks out or a month out. So sometimes it's better to close them early, take profit, and then put on another trade. The final step is to do it again and again. So you are constantly collecting premium and constantly making money. Now, if you want to see the trades that I make personally, including how I trade iron condors for monthly passive income and much more, then you can come join my community on Patreon. The trades that I make for myself, I will put on there, so you can click the link below to check it out. If you want to learn more about options, you can go ahead and watch my other option videos. I recommend these two. This one's pretty good. This one's even better, I think. I really appreciate the support. Thank you so much for watching, and we will see you in the next video.